Rates were cut in the UK and US over the quarter as central bankers look to provide stimulus to both regions now that inflation appears to have receded to near target levels. Further afield in Japan, however, rates were lifted for only the second time since 2007 and signalled to the market that economic reform may finally be underway after decades in the doldrums. Collectively, these rates moves created a wave of volatility across the bond markets, equity markets and the currency markets, with some of the largest intraday movements seen since Black Monday in 1987. The Middle East conflict intensified near the end of the quarter, and at this stage, equity and bond markets appear to have taken this into strides, but oil prices have moved up and could move further should there be further escalation. Yields on the US and UK government bond markets fell on the expectation of rate cuts during Q3. This provided healthy returns for the quarter, although the bulk of this return came during July in anticipation of the actual cuts. Post the cuts, yield movements have been more subdued in the UK than the US, as bond markets contemplate whether the UK will be as aggressive in its cutting approach. Corporate bonds have delivered attractive returns over the past 12 months on the back of lowering interest rates and further tightening of credit spreads. There is further room for returns, but picking the correct bonds is now more important. Whilst bonds have provided a healthy level of return in the last 12 months, yields remain attractive and will look even more attractive should the market become concerned about economic growth. It was a mixed bag for equity market regions over the quarter, with return leadership in sterling terms changing hands on several occasions. Most notable was the absence of the US market dominating sterling returns, although much of this was due to the strong depreciation of the US dollar relative to sterling, rather than the performance of the underlying market. Following the small rate hike in Japan, the market fell by 20% in yen terms in one day, although much of this was offset for the sterling investor given the strengthening yen. The Asian and the emerging market regions ended the quarter strongly following stimulus packages provided by the People's Bank of China. As we look back at Q3, the dominant theme has undoubtedly been volatility due to changes in rates and a possible economic slowdown, particularly in the US. However, in addition to these challenges, we now need to be keeping one eye on the developments in the Middle East. Equity and bond markets appear to have taken this in their stride to date. However, oil prices have moved up on the back of this and may continue to do so if a significant escalation occurs. We will remain watchful of these events, and while such circumstances can be unnerving in the short term, we must remain focused on the long term, and with a slow but still growing economic backdrop combined with strong corporate earnings, the long-term backdrop for risk assets looks favourable.